Good morning, students. Welcome you once again. Fourth lecture on Ind AS 116, which is on lease accounting. Ind AS 116 is on leases. So, students, as promised, today I will do the revision of the last three classes. I will complete the lessor accounting in terms of finance lease, and of course, I'll cover this accounting with the help of a practical question. Then I will be covering the sublease concept, and at last, I will be covering the sale and leaseback transaction. Quickly in the next 15 minutes, let's do the recap of the the concepts of the last three classes. And then I will be covering the finance lease accounting in terms of the books of accounts of the lessor. So students, we have understood that in our accounting standard scenario, there was AS 19 on leases. And globally, there is IFRS 16, which is from GFRS paper perspective. And in financial reporting, it is Ind AS 116 leases. And this lease standard has completely been changed in comparison to accounting standard 19, in comparison to old IAS 17 or Ind AS 17. This standard has completely been changed in terms of the lessee accounting in the books of the lessee, right? And this standard was notified by Ministry of Corporate Affairs in India on 31st. So this standard is applicable from 1st January 2019. This standard was notified on 30th March 2019. Okay. And we have understood that in this standard, from the lessee perspective, there is no any concept of operating lease or finance lease, because lessee is someone who is using the asset, who is getting the right to control the use of the asset. And that is why lessee has to recognize the asset in terms of rights to use, which is ROU asset. And since lessee is recognizing the right to use asset, he has to recognize the leasehold liability as well, right? And in earlier version of the standards, where we were showing the rent expense in the P&L, in this standard we have to charge depreciation on the right of use asset, and we have to charge interest. We have to charge depreciation on the right of use asset, and we have to charge interest on the lease liability, right? This is what we have to do in terms of this standard. Okay. Then we have discussed in this standard, we have discussed the meaning of leases, the scope of the lease, the meaning of the lease, and the meaning of the lease has been changed from the earlier version of the lease standard, which is like a contract where there is a transfer of right to control the use, not right to use, right to control the use of a identified asset for a consideration and for a specific period of time, right? Then we discussed what is meant by identified asset. An identified asset is an asset which is explicitly or implicitly identified in the contract, right? And the lessor should not have the substantive substitution right. The lessor cannot alter the asset, cannot change the asset, cannot replace the asset just due to his own benefit, right? The lessor has to replace the asset for the lessee's benefit. Then you cannot say that the lessor has a substantive substitution right. For example, lessor has replaced the car, right? Why? Because the model which lessor has given to you, it was a very high-end model. So now lessor wants to transfer this car from you to some other person, because that other person is ready to pay more, ready to pay extra in comparison to you. So it means, number one, lessor is replacing the car with the other car to you. Second, the lessor is getting a benefit out of it, right? So in this case, lessor has a substantive substitution right, and this asset should not be considered as an identified asset, and this asset should not meet the definition of the lease contract, and hence this kind of arrangement will not cover under Ind AS 116. Whatever expense you will pay, it will recognize in the P&L. There is no ROU, no leasehold liability, nothing, right? But at the same time, due to the service which is required in the car, due to the damage of the car, the lessor is replacing the asset. So in this case, the lessor is replacing the asset for the lessee's benefits. In this case, it will be considered as a identified asset. Then we have discussed the concept of the right to control of the use of an asset. In right to control the use of an asset, when we can say that the lessor is transferring the rights in terms of control the use of an asset. The lessor is not transferring the rights to use. The lessor is transferring the right to control the use. So it is lessee who is controlling the use of the asset. How you can say that? So you can say that in two terms. One, the lessee is getting all the substantial economic benefit with respect to use of the asset. Second, the lessee is having a right to direct the use, means it is the lessee who will decide how to use this asset and for what purpose this asset is going to be used, right? If the lessor has a protective right, of course the lessor will have the protective right. Lessor will have the protective right because ultimate owner is the lessor only. Then you cannot say that the lessee does not have a right to direct the use or right to control the use. See, if you go by the substance in this entire standard, the word is right to use, the word is use, the word is control the use, right? The word is not talking about the ownership. The word is only talking about the use. So wherever the benefits are transferred, wherever the rights are transferred, these are only transferred with respect to the uses of the asset, right? I'm not going into more detail. I'm just recapping or revising the concept with the help of example as well, right? Then, friends, we have discussed the meaning of inception date of the lease, and inception of the lease is the date when the agreement has been finalized, when the final terms and condition has been decided. Okay. And friend, this is the date when the parties will decide whether it is a lease contract. So you must be wondering, sir, what is this? Party will decide. We know that it is a lease contract. Friend, you have to check whether it is a identified asset, whether the right to control the use of an asset has been transferred, right? In that case, you have to see that, because when in the practical life, when you jump into the industry or consulting, and when you analyze the lease contract, you will find that the lessee does not have the right to control the use. It is the lessor who have a right to control the use. The agreement has been drafted in such a manner where it has been written that the lessor will decide that how to use this asset. The lessor will decide the usage. The lessor has told, and time to time the lessor will visit the premises to ensure that whether the asset has been used in that manner or not. What does it mean? It means right to control the use is still lying with the lessor. It is not the lessee, it is lying with the lessor, right? And that is why, friends, on the inception date of the lease, it is important to identify whether it is a lease transactions or not. Okay. And lessor will classify. So I told you, from the lessee perspective, there is no classification of operating lease and finance lease. But from the lessor perspective, still the classification persists. Still the classification hold good. Why? I have told you, right? So lessor will classify the lease into finance lease or operating lease. On the commencement date of the lease means when the lessee has got a right to control the use, lessee has got the possession, lessee has occupied the property or occupied the asset. So in that case, on the commencement date, the accounting will start. Okay, I mean to say the lease has to be recognized and the lease term is going to be finalized. Okay. Then, friends, we discuss any lease accounting. How will you calculate right of use asset and lease liability? Right of use asset has to be recognized on the basis of present value of future lease payment. I mean to say, future lease payment, we need to understand what is future lease payment. And when you have to calculate present value, you need to understand how this present value has to be calculated. Of course, we need a time period. So what time period? Means lease term. So what is meaning of lease term, which is defined in Ind AS 116? It says that lease term means non-cancelable period, which cannot be cancelled, or if cancelled, you have to pay the penalty. You have to compensate the lessor. Non-cancelable period plus rent-free period plus optional renewal period if lessee is reasonably certain that he will exercise the option. Optional termination period if the lessee is reasonably certain that he will not exercise the termination option. Optional renewal period is the positive term. Optional termination period is the negative term. That's why while writing the solution, you have to be a bit cognizant. Even sometimes when I'm speaking fluently, so sometimes I also miss that, right? I used to say that reasonably certain to exercise that optional termination period will avail. So it is not that. It is reasonably certain not to exercise the optional termination period. Okay. So you have to be a bit cognizant about that. So lease term we have discussed in detail, and we have discussed that in terms of a termination option. When the termination option period, for example, the total period is 10 years, but the last 2 year is a termination option, right? Where the lessee can terminate the contract, or the lessor can terminate the contract, or both the parties have a right to terminate the contract. Now the question arises in this 10-year contract, whether 8 year will be the lease period or 10-year will be the lease period. So in this case, if both the parties have a right to terminate, in that case, you will not consider the optional termination period, and the lease term will be 8 years in this case. But if the lessee has the option to terminate the contract only, in that case, you have to check whether lessee is reasonably certain to not to exercise the termination option. If he is certain, then you have to take the optional termination period. You have to take the optional termination period in the lease term, means the lease term would be 10 years. If the lessor has an optional termination period, in that case, it will be 10 years, right? Because we are looking from the lessee perspective. Okay. Then we discussed that lease term needs to be reassessed, right? When there is a change in the circumstances, right? For example, earlier the lessee was not certain that he will avail the termination option or he will avail the renewal option, but now he is certain that he will avail that options, right? Then we discuss the future lease payment, and it is important to calculate the right of use assets and leasehold liability from the lessee perspective. From the lessor perspective, it is important in case of finance lease accounting. Okay. Otherwise, in operating lease accounting, everything goes to the income. So that's not the critical thing. But of course, from the finance lease perspective, where the lessor has to capitalize the lease receivable, in that case, he has to calculate it on the basis of present value of the future lease payments. So friends, in terms of the future lease payments from the lessee perspective, there are 5 elements out of it. 1, fixed payment plus in substance fixed payment. Example could be fixed payment. For example, 1 lakh rupees fixed payment every year with a 10% increase or escalation every year. So this 10% increase, you know today that I have to pay this amount of payment in the next 10 years, right? How come you, which is depending on the index or a rate, like wholesale price index, consumer price index, inflation rate, right? If your lease payment is in line with this kind of index or a rate in many industry, when you go to the industrial area, you know how these lease contracts have been made. The lease contracts have been made in such a scenario like the increase will be on the basis of inflation rate, right? Or the increase will be on the basis of wholesale price index. Okay. In that case, while estimating the lease payment, it has to be considered as a future lease payment. Sir, what happens if the variable lease is depending on the quantity volume of the production? In that case, it will not be considered as a future lease payment. It will be considered in the P&L directly. It means whenever that variable lease payment will come, it will directly go to the P&L. It will not become part of the lease liability and ROU asset, right? Third, if there is a exercise, if there is a purchase option, then if the whatever exercise price of the purchase option is there, that has to be taken into consideration for calculating the future lease payment. If there are penalties for terminating the lease and lessee is reasonably certain that yes, I will have to incur the penalty, that payment of in regard to penalty is also part of the lease payments. Residual value guaranteed by the lessee. The lessee has guaranteed to the lessor, see, I have to pay you 20,000 rupees, or you will get 20,000 rupees at least minimum. These are the 5 elements from the perspective of the lessee. But if you will calculate from the perspective of the lessor in terms of finance lease accounting, so in that case, apart from these 5 elements, the residual, if the residual value is guaranteed not by the lessee, but any other third party or any other party which is related to the lessee, that is also required to be included. Right, friends? Then we discuss interest rate implicit in the lease. Interest rate means discount rate. Which kind of discount rate needs to be taken? Standard says that you have to take that kind of discount rate which equalizes the net investment in the lease. What is meant by net investment in the lease from the lessor perspective? The net investment in the lease means present value of future lease payments to the lessor. What is meant by future lease payment to the lessor? This item which I have shown you recently. Present value of future lease payment plus unguaranteed residual value. If the lessor has some unguaranteed residual value, for example, you guys are aware, in case of property, plant and equipment, what we are doing? In case of property, plant and equipment, we are also estimating residual value, right? In tower companies, what these tower companies are doing, these telecom tower companies, Let's say the cost of the tower is 20 lakh rupees and their useful life is 20 years. So at the end of the 20 years, probably they are estimating that I will be able to fetch 10% of the amount as a residual value, right? How come it is possible? Because this tower is made of structured steel, right? This tower is made of steel, iron. So some kind of, material is there. So in that case, generally what happens in that case, they will be able to fetch some money as a residual value. This is known as an unguaranteed residual value because no one is giving guarantee. For example, if you're selling a battery as a scrap, right? So you will get a good amount of this as a scrap sale. Why? Because there is a copper which is inbuilt in the battery. So you will be able to sell that copper, okay? And you will get some good amount of money. So what is that? That is an unguaranteed residual value. So the concept of discount rate says that it should be interest rate implicit in the lease. What is meant by interest rate implicit in the lease? It means that it is that discount rate, it is that interest rate which equalizes the net investment in the lease to the lessor is equal to fair value of the asset, right? But the point is, in 99% cases, how the lessee will be able to know about the interest rate implicit in the lease to the lessor. It means lessee will not be able to understand that what is the lessor's borrowing rate, what is the lessor interest rate, which equalizes the money which the lessor is receiving is equal to the fair value of that asset. So in that case, standard says that if it is not possible to know about the lessor's borrowing rate, in that case, you can take the lessee's incremental borrowing rate. That what is the borrowing rate applicable to the lessee, because the lessee is doing this accounting. Okay, is that clear? Initial direct cost is your incremental cost of obtaining a lease, like commission, brokerage, stamp duty. These are the lease documentation charges. These are the initial direct cost examples. Right, friends? Then we discuss the accounting in the books of the lessee. I hope you guys are able to relate, recap, revise, and recall all the topics which is related to the last 3 days. I hope you find it very useful. Yeah. Is that clear? Okay. Yes. So coming to the treatment in the books of the lessee, Mansa is saying that I could not attend the last lecture. No, Mansa, there will not be a major problem, right? Because I am going to revise all these concepts today. Janvi is saying, sir, please explain illustration number 37. Janvi, illustration number 37 is related to which topic? Please write on the chat box. Yeah. Then coming to the treatment in the book of the lessee, and we understood that lessee has to capitalize right of use asset and the lessee has to credit lease liability. So lessee has to capitalize right of use asset, and right of use asset is the aggregate of 4 things. What is the 4 things? Number 1, the future lease payments, the present value of the future lease payment. Okay. The lessee has to calculate the lease liability, I mean to say future lease payment, and the lessee has to discount using the present value factor. Lessee has to credit. If the lessee has paid any amount before commencement date, like advance rent, the lessee has to credit that and lessee has to debit right of use asset. If the lessee is incurring any cost, for example, lessee is paying the stamp duty charges, lessee is paying a commission or brokerage, so that has also required to be capitalized as a right to use asset. Like in case of property, plant and equipment, you are also capitalizing these kind of costs. Fourth, if the contract says that after 10 years or 20 years, when lessee will wind up or terminate this contract, lessee has to restore the lessor place in the same condition in which the lessor has given to the lessee. So there will be a asset retirement obligation or site restoration obligation, and classic example is the telecom tower companies. When the telecom tower companies construct tower, it is on the leasehold properties, it is on the leasehold land, right? Or it is on the leasehold rooftop. So there is a agreement, there is a condition in the agreement that whenever the tower company will go, they have to dismantle the tower, they have to restore the place in the same condition in which the lessor has given to them. So friends, if that is there, so that provision has to be credited, because this liability will incur in future, but the present value of the future asset retirement obligation, the present value has to be debited to the right of use asset. Okay. So this is how the initial accounting has to happen, right? And friends, we have also discussed that in with this right of use accounting and lease liability accounting, we have two kind of exemption. One is exemption with respect to short-term leases and exemption with respect to low-value leases, right? What is meant by short-term leases? Short-term leases are that lease period which is 12 months or less. Sir, what is meant by lease period? Again, non-cancelable period plus rent-free period plus optional renewal period plus optional termination period, right? And friends, if the lessee and the lessor entered into a contract where the agreement is only for 11 months, but the lessee is getting a right to purchase option, in that case, it will not be considered as a short-term leases. Second, low value leases. What do you mean by low value leases? Low value leases means those leases where the underlying asset is very is of a insignificant or immaterial value. For example, computer, tablet, right? Don't see from the perspective of a student. For example, you will say that, sir, my stipend is just 3,000 rupees per month. So 15,000 tablet is a material amount for me. All right, 50,000 computer or a laptop is a material amount for me. I'm talking from the perspective of the industry or the companies, right? So you need to look at that. So friends, if the lessor is giving these kind of items on a lease basis, for example, the classic example is a coffee or vending machine, coffee vending machine, tea vending machine. So lessor is transferring these item to the lessee, and the lessee is also transferring these item to the further another lessee, right? So it means if these kind of item is subleased to the another lessee, in that case it will be considered as a it will not be considered as a low value leases. Okay, then we have done some case studies on that. And friends, then we discuss the subsequent measurement accounting, and we discuss that in case of right of use asset, you have to recognize the right of use asset either on the basis of cost model or on the basis of the revaluation model, right? The same model which was there in the PPE standard, property plant and equipment Ind AS 16 standard. And even 116 says that you have to apply all the terms and conditions, all the provisions of Ind AS 16 in terms of this cost model and revaluation model. What is meant by cost model and revaluation model? How to compute the carrying value? It is cost minus accumulated depreciation minus accumulated impairment, right? So this is there, friends. And basically, so in case of subsequent measurement, first of all, you have to depreciate that right of use asset, and you have to also do the impairment testing of the right of use asset. As you are aware that whatever asset is there on the balance sheet, it is subject to impairment. If the condition becomes worse, you have to see from the eyes of the impairment testing, right? And friends, how to compute the depreciation? Depreciation has to be calculated on the basis of the useful life of the asset. Okay. So depreciation has to be on the straight line method, and you have to apply Ind AS 16 principles for the depreciation. Sir, if my term is changing, if my options are changing, for example, earlier I was not sure that I will renew the period, but now I'm sure that I'll renew the period, right? So of course, whenever the lease term is changing, if there is a modification in terms of change in lease term, in terms of change in consideration, so you have to remeasure your lease liability, and accordingly you have to adjust your right of use asset. And we did two practical example yesterday on the modification of the lease accounting, right? Is that clear? Coming to the lease liability will be increased by putting the interest on that. So finance cost will be there. On ROU asset, depreciation will be there. On lease liability, finance cost will be there. And lease liability will be reduced by the payment of the rent. Okay. So friends, if I talk about the P&L, in terms of P&L, in terms of balance sheet, right of use asset will be there and lease liability will be there. In terms of P&L, the depreciation on the ROU asset is required to be charged. Interest expense on the lease liability is required to be charged. And the variable lease payment, which is not depending on the index or rate, like for example, which is depending on the volume of the production, which is depending on the quantity, right? Which is depending on the usage. In that case, it will go to the P&L. And if there is any impairment of the ROU asset, it will also go to the P&L, right? Then we did some lessee accounting also. We did 4 examples in terms of lessee accounting. Then we discussed that in a contract where there are lease component as well as non-lease component. First of all, if it is not easy to separate the lease and non-lease component, the standard has given you a practical expedient Standard has given you an exemption that you can consider the entire contract as a lease contract, right? But before taking that practical expedient, you have to ensure that you are not able to determine that. But sir, if there is a payment on account of rent and payment on account of maintenance, it is pretty simple that yes, rent is a lease component, maintenance is a non-lease component, right? In that case, you need to allocate that. Now, why this separation thing is there? Because what happens generally, the lessor and the lessee do some planning, right? Like the lessor says that, okay, don't give me maintenance, give me 100% rent, okay? In term, you give me 100% on account of rent, or just make my rent lower and increase my maintenance charges. So at times they are planning this consideration. So standard says that if there are in a lease in a contract there are lease component as well as non-lease component, then whatever consideration as a lessee, whatever consideration you are paying to the lessor, you have to allocate that consideration into the fair value of the lease component and the non-lease component, right? So you have to see this independently. If I would not take maintenance services, I would only take the rental services, what should be the rent? If I would only take the maintenance services, what would be the charges, right? So you have to allocate the consideration paid into the fair value of the lease and non-lease component. And we did one of the case study from ICS study material as well. Then friends, we discuss what happens when there is a lease modification. Then there is a change in the scope of the lease, or there is a change in the consideration of the lease, right? Which was not part of the original terms and condition of the lease. In that case, we have understood that there could be three scenario, right? There could be three scenario, okay? And I have summarized in this chart. So this is a lease modification. This is a modification summary. Modification summary. So friends, I have discussed that whenever there is an increase in scope means the scope is increasing. Earlier you have taken 2 rooms, now you are going to take 4 rooms on a rent basis, right? So if there is an increase in scope and increase in scope is in line with the increase in lease rent, which is at market value, then it will be considered as a new lease and you are not required to discontinue or disturb your initial ROU and lease liability accounting, right? If there is an increase in scope, but there is a heavy discount as a part of the whole contract. So if the increase in scope is not in line with the increase in lease rent, right? Or there is an increase in lease term, there is an increase in consideration. In that case, you have to remeasure the lease liability at the modification date. You have to adjust the ROU asset as well, right? So friends, if there is an increase in scope, and increase in scope is like an increase in lease rent. Basically, you are increasing the scope, but you are not getting any benefit. So what does it mean? It means you are just like a new contract, you new lessee. So it will be considered as a new lease. But there is an increase in scope due to having a huge space. You are getting a huge discount in the whole contract. So this increase in scope is not in line with the increase in lease rent. In that case, you are required to remeasure your lease liability as per the revised terms and condition on the modification date, and you have to adjust the right of use asset with that. Okay. So friends, in case of increase in lease term, in case of increase in consideration, in case of increase in scope, which is not in line of the increase in lease rent, you have to remeasure the lease liability at the modification date. But friends, whenever either the lease term is decreasing or the scope is decreasing, in that case, you have to de-recognize the right of use asset and lease liability partially. Wherever the difference will be there, it will always go to the P&L. And friends, we discussed a lot of case studies on the lease modification, right? We discussed a lot of case studies on the lease modification. Then we discussed lessor accounting, and we discussed like in lessee, there is no concept of operating lease and finance lease, but in lessor, since lessor is the owner of the asset, and the asset comes first in the books of the lessor, and that is why the concept of operating lease and finance lease is there in the books of the lessor. If the risk and reward is getting transferred to the lessee, in that case, it will be considered as a finance lease from the perspective of the lessor. But if the risk and reward is not transferred to the lessee, then it will be considered as an operating lease in the books of the lessor. If it is an operating lease in the books of the lessor will always continue to recognize the asset, main asset in its books of accounts like a owner. If it is a finance lease, then lessor will de-recognize the asset and lessor will recognize the finance lease receivable. which is present value of future lease payments, right? Like in case of a lessee was recognizing right of use asset on the basis of present value of future lease payments. Lessor has also required to recognize a finance lease receivable on the basis of present value of the future lease payments receivables. Okay. We discussed this concept and we discussed that what are the indicators of finance lease. There are 5 indicators of finance lease. For example, while as an auditor, while looking at the lease contract, you have find that, oh, at the end of the lease term, there is a transfer of ownership to the lessee. It means it is an indicator of the finance lease. Second, there is a purchase option which is available in the contract, and it also says that the exercise price of the purchase option is much lesser than whatever the market value of that asset will be there. Okay. Lease term, and the lease term is for the major part of the economic life of the asset. The lease term is for the major part of the economic life of the asset, even if the title is not transferred. Present value of minimum lease payment. So at the inception date, the present value. So what is meant by a major part of the economic life of the asset means, for example, the life of the asset is 10 years. So if the lessor has given it on the lease basis for more than 5 years, so you can say that the lease is covering the major part of the economic life of the asset. This is one of the indicator. Okay. At the inception date, whatever the lessor is charging, in that case, the present value of the future lease payment is somehow equivalent to the present value of the future lease payment is equivalent to the fair value of the lease asset today, right? So it is also one of the indicator of the finance lease. It means the lessor is getting the entire money equivalent to the market value of the asset as of now. And if the asset is manufactured, produced on the for specifically for the lessee, in that case, you know, it is again an indicator of the finance lease, right? Then we discussed that initial recognition in the books of the lessor. If it is an operating lease, in that case, simple. Whatever money will come, the lessor will recognize the rental income and the lessor will depreciate its original asset in the books of accounts. But if it is a finance lease, the lessor has to recognize the finance lease receivable and the lessor has to de-recognize its underlying asset. The finance lease receivable has to be recognized on the basis of net investment in the lease, which is equivalent to the what? Present value of the future lease payment plus unguaranteed residual value. Since I have covered last 3 questions completely. Right? So Namrata, variable lease payment depend upon rate. I'm not able to understand, sir. So Namrata, variable lease payments depending on the index or a rate. Rate means inflation rate, right? If there are some indices, right, like inflation rate, okay, like growth in the GDP. So in that case, it will be considered as a variable lease payment included in the future lease payments. But if this kind of thing will not be there, for example, the variable lease payment will be on the basis of volume of production, on the basis of usage. So it is not on the basis of any index, it is not on the basis of any rate. It is simple on the basis of the increase in production. So it means it is actually contingent, it is actually variable, right? And in that case, you have to take it to the P&L. You are not required to consider in the present value of the future lease payment. Okay. Is that clear? Illustration number 37. Janvi is saying, sir, illustration number 37. Okay. Let me see that illustration number 37. Janvi, illustration number 37 is with respect to modification that both increases and decreases the scope of the lease, right? Which increases the scope of the lease and decreases the scope of the lease. So let me share this illustration number 37. I hope this illustration number 37 is visible from the ICI study material. Yeah. So it's a very long illustration and I have to cover three even important concepts. So let me explain this illustration, right? So that you will be able to understand this. I hope my study material is visible to all of you guys. I hope it is visible. Lessee enters into a 10-year lease for 2,000 square meter of office space. The annual lease payments are 1 lakh payable at the end of each year. In this case, the underlying asset is 2,000 square meter and the lease payments, right? And if you want to write, I want that each one of you should have a notepad and each one of you should have a pen or pencil, and please write the things which I am explaining to you. And you know how to solve any big problem. So the underlying rule is, if you want to solve a big problem, that just cut into the pieces, right? Make it a smaller problem and then solve it. So this is a big question, and but we will just divide this question, we'll break this question into a smaller pieces. Lessee enters into a 10-year lease for 2,000 square meter of office space. In the first line, the lease term is given, which is 10 year. In the second line, the annual lease payment is given, which is 1 lakh rupees payable at the end of each year. It is very important from the perspective of calculating the present value, right? If it should be at the beginning of the each year, then for the first year, the present value factor will always be 1. So the lease payment is 1 lakh. Interest rate implicit in the lease cannot be readily determined, I have told you, but the lessee incremental borrowing rate is 6%. Lease term is given, lease payment is given, and the discount rate is given in the first paragraph. At the beginning of year 6 means end of year 5, means after 5 years, right? After 5 years, when the 5 payment of the rent has been already made, lessee and lessor agree to amend the original lease. So it means in the initial 5 year, there is no any problem, right? And at the inception date, at the commencement date, you have done the right of use asset accounting, you have done the lease liability accounting. So on the basis of 1 lakh rupees, you have calculated the present value of the future lease payments on the basis of 1 lakh rupees each year, right? And discount rate is 6%. You have calculated the present value factor. Am I right? This is pretty simple. This is pretty simple. First of all, what was the first step? The first step is to compute the right of use asset, compute the lease liability, compute the carrying value of right of use asset and lease liability on the modification date. This is what I told you. In case of any modification, this is what I told you, right? यही बताया था ना मैंने आपको, I have told you this thing only, right? And let me show you what I have told you in terms of any illustration. Modification concept. Calculate present value of lease payment on the basis of original lease, then prepare lease liability schedule, then calculate ROU and lease liability on the modification date. The point is, you need to compute right of use asset, lease liability, and the carrying value on the modification date. That's all. That's all, guys. In this case, if you will see, the pre-modification right of use asset and pre-modification lease liability in relation to the leases are as follows, right? So let's go to the note number 4, where the first, second, and third step would be there. The first and second step would be there. See, note number 4, right? Calculation of initial value of ROU asset and lease liability. Initial value of ROU asset and lease liability, right? Initial value of ROU asset and lease liability. This is given in there, in this thing. Okay. So in this case, the simple thing, for the at the commencement date, the right set on the basis of present value of the future liability is 735,900, right? 735,900. What is the accounting entry? Right of use asset account debit to lease liability 735,900. This is the first step. Second step, compute lease liability schedule. Then in this standard, in this question, the lease liability schedule have been prepared. Opening balance 735, interest 6%, payment 1 lakh, closing balance this much opening balance. At the end of the 5 year, what is your lease liability carrying value? 421090. At the end of the 5 year, what is the carrying value of the ROU asset? 367950. And you can see that the depreciation is charging every year, right? So step number 1, compute present value of lease liability on the basis of original lease terms. Step number 2, prepare lease liability schedule. Why? Because you have to find out the carrying value on the modification date, right? Then step number 3, calculate carrying value of ROU asset and carrying value of lease liability on the modification date. So if this question would be of 10 marks, you have already covered 3 marks, right? You have already covered 3 or 4 marks. Is that clear? You have already covered 3 or 4 marks by simple doing ROU asset and lease liability accounting over a period of lease term. You secured 40% marks. Now it says that at the beginning of year 6, lessee and lessor agreed to amend the original lease to include an additional 1500 square meter of space in the same building starting from the beginning of year 6. So there is an increase in scope by 1500 square meter. Reduce the lease term from 10 years to 8 years. There is a decrease in lease term also. There is an increase in scope in terms of additional space. There is a decrease in scope in terms of decrease in lease term. The annual fixed payment for the 3500 square meter is 1,50,000 payable at the end of each year from year 6 to year 8. And the annual fixed payment is for 3500 is 1,50,000. So friends, for 2000 it was 1 lakh rupees. For 2000 meter it was 1 lakh rupees. So what is the price? What is the price per meter? What is the price per meter? 1 lakh divided by 2000. It is 50 rupees. It is 50 rupees per square meter. It is 50 rupees per square meter. But for increase in 1500 square meter of space, the increase is only 50,000 rupees. So 50,000 divided by 1500, how much it is coming? It is coming around 37 rupees. It means the consideration for the increase in scope of 1500 square meter of space is not commensurate with the fair value for that increase adjusted to reflect the circumstances of the contract. It is also written there is an increase in scope, but increase in scope is not in line with the increase in market prices. What does it mean? It means there is no separate lease. It is a modification of the existing lease. So friends, in this question, there are two kinds of modification. One, increase in scope, but it is not related, but it is not identical to the increase in prices. It means, what does it mean? It means you have to remeasure the lease liability and you have to adjust it to the ROU asset. Number one. Number two, there is a decrease in lease term, right? So again, it says that in case of a decrease in lease term, you have to partially de-recognize the right of use asset and you have to de-recognize the lease liability. Consequently, lessee does not account for the increase in scope that adds the right to use an additional 1500 square meter of space as a separate lease. We are aware. How should be the said modification accounted for? In this case, friends, for the initial computation of ROU, lease liability, computation of carrying value of the ROU asset and lease liability on the modification date, we are quite clear. But at the same date, two things are happening. One, the lease term is decreasing. Number two, the asset is the space is increasing. There are two things. So friends, in this case, what we are required to do? There are three things which are happening. Number one, there is an increase in scope due to increase in consideration. Increase in consideration is not identical to the increase in scope. So first of all, you have to remeasure your lease liability, right? And you have to remeasure your lease liability for the next 5 year. Answer is no. You have to remeasure the lease liability for a period of 3 years, next 3 years. So if I need to pay today, sitting on the beginning of year 6, I have to pay three rentals for 1,50,000 rupees each, right? And of course, the interest rate is 7%. The lessee incremental borrowing rate is 7%. So it means, first of all, I need to compute the lease liability, the revised lease liability on the modification date. So 1,50,000, and we have discounted at the rate of 7%, right? So it gives us 393,600. 393,600, this will give us. The modified lease liability is 393,600, right? 393,600. Friends, if I am talking about the decrease in lease term, right? What is my pre-modification ROU? What is my pre-modification ROU? My pre-modification ROU, it is given in the question. Please write down your pre-modification ROU on the modification date is 367,950. Lease liability on the modification date is 421,090. The revised lease liability on the modification date is 393,600. For existing lease liability is 421,090. Revised lease liability is 393,600. You can see that your lease liability is also decreasing, right? Your lease liability is also decreasing. And friends, if this increase in scope would not have been there, if the first condition would not have been there in the question, then what will happen? If in the question only it is written that at the beginning of the year 6 they have decided to reduce the lease term from 10 year to 8 years, then what you would do? Then what you will do? You have to de-recognize your right of use asset and leasehold obligation. You have to de-recognize, right? Right of use asset and leasehold obligation. Am I right? You have to remeasure your lease liability on the basis of 1 lakh rupees for the next 3 years. Okay. And you have to de-recognize your ROU asset also. The carrying value of ROU asset is 367,950. And it was supposed to be depreciated in the next 5 years. But due to decrease in lease term, now it is only supposed to be depreciated for 3 years only. But this ROU asset has been measured as per the 10-year life, not as per the 8-year life. It means this ROU asset, the remaining value of the ROU asset is related to the next 5 years, not only 3 years. It means you have to compute the proportionate ROU, right? That what will be my proportionate ROU? The remaining ROU asset, original 2,000 square meter of office space is 227,770. How come it is calculated? 367,950 divided by 5 into 3 years, right? This has given you the proportionate right of use asset. Proportionate right of use asset. And what is your existing lease liability? It is 421,090. 421,090. What is your remaining lease liability? What is your remaining lease liability for the original 2,000 square meter of office space? What is that? That is, you have to compute on the basis of 1 lakh rupees. When you compute on the basis of 1 lakh rupees for the 3 years, it will comes out to, let me show you the calculation. Note number 2. Calculation of remaining lease liability for the original contract of 2,000 square meter of original discount rate, right? It is coming out at 267,300. So for the decrease in lease term, right? For the decrease in lease term, it is coming out at 267,300, right? 267,300. If I only talk about the decrease in lease term, my ROU asset comes out at 220,770. My lease liability comes out at 267,300, right? 267,300. So in this case, what was my original ROU asset? 367,950. What is my, due to decrease in lease term, what is the derecognition of ROU asset? 367,950 minus 220,770, which is comes out at 147,180. And what is your carrying value of the lease liability? The carrying value of the lease liability on the date of modification was 421,090. And on the basis of the revised lease term is 267,300. So your lease liability will be decreased by 153,790. Your lease asset, ROU asset, will be decreased by 147,180. So friends, what accounting entry you need to pass? You need to debit lease liability by 153,790. You need to credit ROU asset by 147,180. The difference will go to the P&L. This is your accounting entry. The difference will go to the P&L. Is that clear? Is that clear, friends? Or it is not clear? Friends, now let me summarize. First of all, you have computed the original right of use asset. How you have computed? You have computed by present value of the future lease payment, which is 1 lakh for the period of 10 years at the rate of 6%. Is that clear? Then you have prepared a lease liability schedule and you have computed the carrying value of ROU asset and the carrying value of lease liability, which comes out for ROU asset, it is 367,950, and for lease liability, it is 421,090. Then, since if this 1500 square meter office space would not have been added, still there is a decrease in lease term by 2 years. So you have computed the revised lease liability on the basis of the original discount rate. So remaining lease liability is for the remaining 3 years, 1 lakh rupees at the rate of 6%. So it comes out at 267,300, the revised lease liability, if we will only decreasing the lease term. And your proportionate ROU asset comes out at 220,770. It means there is a decrease of lease liability by 1,53,790. There is a decrease of ROU asset by 1,47,180. So you will debit liability, you will credit the asset, and you will have some P&L impact also, which is the difference between the derecognition of asset and derecognition of liability, right? So finally, friends, your revised ROU comes out at what? Revised ROU comes out at what is the value of the revised ROU? The value of the revised ROU is 220,770 and the revised of lease liability is 267,300, right? And there is a P&L gain of 66710. Is that clear to everyone so far? And when you computed and done this step, you have secured out of 10 marks, you have covered 6 marks, right? You have covered 6 marks. Namrata, lease liability will never be taken on a proportionate basis. Why? Because the time value of the money is involved. Right of use asset have been taken on a proportionate basis. Why? Because it is depreciating on a straight line method. And once you have recognized the right of use asset, it will not keep on changing, right? It is a fixed amount. But lease liability is not a fixed amount. It keeps on changing. Janvi is saying, sir, in this case, we can't pass single entry difference between 421,090 and 393600. No, Janvi, right? Because in intervening, this will have a P&L impact also, right? So you have to show the effect separately. In accounting, you go by the substance. And what is the substance? You have to show the impact separately, right? So first step, you have computed the original ROU, original lease liability, carrying value of ROU and lease liability on the modification date. Number 2, if the original terms will be there with a change in the lease term only, then my revised lease liability, my revised ROU asset, and whatever difference will be there for derecognition of ROU and LO, it will go to the P&L. Is that clear? Is that clear, friends, or it is not clear? Is that clear? I hope it is clear to all of you. Yeah. Now there is an increase in lease space also. What amount we have now? We have 227. We have 267,300. 267,300. Okay. 267,300 in the lease liability. Friends, what is my revised lease liability on the basis of present value? 393,600. What is the difference between 393,600 and 267? What is the amount? 267,300. What is the difference? 267,300. Please do the calculation on the calculator. Let me calculate that. 267,300 minus 393,600, right? 126,300. 126,300. Okay. 126,300. In this case, now what you are required to do? On the basis of revised lease space, you have to compute the revised lease liability, which is 393,600, and your existing lease liability means after modification of the lease term, it is 267,300. It means your lease liability is going to be increased by how much? 126,300. You can net these two entries. You can net off these two entries, right? 126,300. 126,300. So you have to credit your lease liability by 126,300 and you have to debit your right of use asset by 126,300. This is the third. This is the third accounting entry which we are required to pass. So friend, to summarize illustration number 37, and please write down. Please write down on the notebook. Illustration number 37. Please write down on the notebook. Step number 1. Step number 1. Compute right of use asset and lease liability on the basis of original terms and conditions, and compute carrying value of right of use asset and lease liability on the date of modification within bracket, that is at the end of 5 years. Step number 2, compute revised lease liability on the basis of decrease in lease term and reduce the right of use asset proportionately for a period of 3 years. And the second part of step 2 is the impact of decrease in lease liability and decrease in ROU asset. If there is any difference, the difference will go to the P&L. Like I have shown you this entry, the difference has gone in the P&L 6610, right? This entry. Step number 3, then compute revised lease liability on the basis of increase in space, increase in scope. Compare the revised lease liability with the lease liability came in step number 2. Whatever increase in lease liability is there, you have to debit that increase to ROU and credit to the lease liability, right? This is what this entire illustration number 37 is there. Janvi, thanks for asking for this illustration, for solving and explaining this illustration. And let me tell you, this illustration, if this illustration would be asked in the examination, it will be for 10 to 12 marks, right? And there will be a stepwise marking. When you complete step number 1, computation of original lease liability, ROU asset and carrying value of lease liability and ROU asset on the date of modification, you will get 3 marks. When you compute step number 2, for example, derecognition of lease liability on the basis of revised lease liability for decrease in lease term, derecognition of proportionate ROU asset, taking the impact to the P&L, it will give you another 3 marks, 3 or 4 marks, right? Then when you compute step number 3, which is computation of revised lease liability on the basis of increase in lease rental and increase in scope, right? And crediting lease liability, debiting ROU asset, it will give you another 3 marks. So this is how step wise marking will happen. And this is the question where the increase in scope and decrease in scope is there, right? The increase in modification and decrease modification will be there. I would say a very good question, right? Okay. I hope you guys have understood this thing. Okay. So illustration number 37, I have completely discussed the illustration number 37, friends. Now, friends, let's discuss the treatment in the books of the lessor. Okay. And I have one question to you to explain you guys that what is the treatment in the books of the lessor. Let me go back to my Excel file. And this is the lessor accounting finance lease. Lessor accounting for operating lease I have covered in the 3rd class. The students who have not attended on a live basis, they can see the recorded class. Yes, accounting in the books of lessor in case of finance lease. Let's take an example. A Limited had purchased a car rupees 8 lakhs on 1st April 2015. After 1 year, A Limited leases out the car to be rupees 1.25 lakh per annum for 4 years. Interest rate implicit in the lease is 10%. Calculate the necessary impact in the book of A Limited. Life of car is 5 years. UGRV, unguaranteed residual value is 50,000. The life of the car, A Limited has purchased a car for rupees 8 lakhs and the life is 5 years only. And he has used the car for the first year and then he decided to lease out that car. It means the car covers the entire economic life and hence it is a finance lease. It is not only major part of the economic life, it is the entire economic life and hence it is a finance lease. Right? Yes. Let me solve this question completely so that you will be able to understand this thing completely. What lessor will do? Accounting in the books of the lessor. Accounting in the books of lessor. On 1st April, 2015, 1st April 2015, what lessor will do? First of all, the lessor has purchased the car account debit. You will go by the PP standard, car account debit to bank account. What is the accounting entry? 8 lakh. 8 lakh rupees. Now, A Limited must have charged the depreciation account debit, accumulated depreciation account, or to car account, to accumulated depreciation account. This is debit, this is credit. What is the amount? 8 lakh divided by 5 is the amount. What is the narration? Being car purchased. Being depreciation charged. I hope this is clear. This is purchase of car entry. This is depreciation entry. I hope it is clear. What is the carrying value of car? What is the carrying value of the car as on 31st March 2016? That is after 1 year. The carrying value of the car is 8 lakh minus 1 lakh 60,000. It is 6 lakh 40,000. The carrying value of the car is 6 lakh 40,000, right? The carrying value of the car is 6 lakh 40,000. Is that clear, friends? The carrying value of the car is 6 lakh 40,000. The lessor, now it is a finance lease. Step number 1, what lessor will do? Lessor will recognize the asset and lessor will recognize the lease receivable equals to the net investment in the lease. Your step number 1. Now, lessor will do the lease classification. What is the lease classification in this case? The remaining period is 4 years and the life is also 4 years. The lease classification is finance lease in the books of the lessor, right? It is a finance lease in the books of the lessor. Is that clear? Is that clear, friends? Is that clear? Whether my voice is audible? Whether my voice is clear? Voice is clear? Ashok ji, am I audible? Okay, so it is fine. Yes. Hence, it is a finance lease in the books of the lessor. Okay, it is a finance lease. Now, how to do this finance lease accounting? Step number 1. In case of finance lease accounting, step number 1. The lessee has to de-recognize the asset. Lessor has to de-recognize this asset. Means the carrying value of 6,40,000, the lessor has to de-recognize this carrying value. De-recognize the asset. Step number 2. Lessor. Step number 2. Lessor has to recognize. First of all, 6,40,000 rupees carrying value of the car is going to be recognized. But lessor has to recognize the finance lease receivable. Receipt on the basis of present value of what? Present value of lease payment plus unguaranteed residual value, UGRV. On the basis of present value of future lease payment and unguaranteed residual value. Okay. Basically, it's the net investment is in lease. Lessor has to recognize the receivable equivalent to the net investment in the lease. What is the net investment in the lease? The net investment in the lease is the present value of the gross investment in lease. What is the gross investment in lease? It is lease payments from the perspective of lessor, which is future lease payment plus unguaranteed residual value, right? Now we need to compute the present value of lease payment, right? We need to compute present value of lease payment. Number one, calculate present value of lease payments. Calculate present value of lease payments. Number one, year, lease payment, present value factor, and this is present value, which is amount. Year 1, 2, 3, 4, right? 4 years are there. What is my lease payment? What is my lease payment, friend? Lease payment is 1,25,000. Lease payment is 1,25,000, right? 1,25,000 is a lease payment. Assuming it is at the end of the each year. In the question it is not given, but when in the question if it is not given, you can assume at the end of the each year and you can write down that thing, right? And there is an unguaranteed residual value also, which is 50,000. Unguaranteed residual value also. So it means at the end of the fourth year, there is a 50,000 of unguaranteed residual value. Now, what is my present value factor? It is 1 divided by 1.1 because it is a 10%. It is 10%, 1 divided by 1.1, right? Present value factor at the rate of 10%. At the rate of 10%. Okay. Then again, this divide by 1.1. Sorry. Divide by 1.1. In the same manner, this will give you 0.683 in the end of the fourth year. And again, for this, it is again 0.660313. Okay. So let me beautify this calculation. And this is my first of all, this is my present value of lease installment, and this is my present value of residual value of UGRV, right? Okay. And this is my present value of the UGRV. And what is my total present value? What is my total present value? My total present value of gross investment, which is your lease payment plus unguaranteed residual value. What is my total present value? It is 396,430,384, right? And let me summarize this also. What is your gross investment? Your gross investment is 1,25,000 plus 50,000. In this case, what is your gross investment? You will find this word in the standard and in the question also. What is your gross investment? Your gross investment in the lease is 1,25,000 multiplied by 4 plus 50,000. This is your gross investment in the lease. And what is your net investment? Your net investment is the present value of the gross investment. Your net investment means present value of the gross investment. Your net investment will be 430,84. This is your net investment in the lease, right? These are the terms which have been used in this standard, right? Since we have calculated the present value of the gross investment, which is the net investment in the lease, at the time of initial recognition, what accounting entry lessor will pass? lessor will pass now on 1st April 2016. So initial recognition of lease in the books of the lessor. What accounting entry lessor will pass? Lessor will debit finance lease receivable account debit. Finance lease receivable account debit, right? Finance lease receivable account debit, and this is on the 1st April 2016, right? Lessor finance lease receivable account debit by 430384 to car account. Car is going to be de-recognized to car account. To car account. Car needs to be credited. And what is this credit? The value of the car, the carrying value of the car was 6,40,000 rupees. In fact, loss on de-recognition, right? There is a loss which is happening on the de-recognition. Loss on de-recognition account debit. And this is the difference between 6,40,000 and 4,30,384. This is how this accounting entry has to happen, right? And this loss on de-recognition will go to the P&L. I hope this accounting entry is clear to all of you. Is that clear? This accounting entry is clear to all of you? Yeah, is that clear? Friends, in case of finance lease, whether this accounting entry is clear, how the lessor has de-recognized the main asset and how the lessor has recognized the lease receivable, finance lease receivable. Is that clear? Clear, not clear? Now, how the subsequent measurement will happen? How the subsequent measurement will happen, right? Now, the lessor will prepare the lease receivable schedule. The lessor will prepare the lease receivable schedule. Prepare lease receivable schedule, right? Again, year. Sorry. There will be 4 years. Year. Then opening balance would be there. Opening balance would be there. Then there is a interest income because it is a lessor who will earn interest income. Interest income at the rate of what? At the rate of 10%. Right? Then there is a lease payment, means lessor will receive. The word uses payment in the standard, right? Even from the so payment does not mean you have to pay only, right? You must have heard about these terms when your father or your elder brother or someone is saying, get the payment from him. जा उससे जाकर payment ले आ. Payment ले आ. Payment means cash, right? Closing balance. What is the opening balance? The opening balance is 430,384. This is the opening balance on which the lease asset has to be created, lease receivable has to be created. What is my interest income at the rate of 10%? Multiply by 10%. What is my lease payment? Minus 1,25,000. What is my closing balance? Opening asset plus interest income minus lease installment received, payment received. Again, in the second year, this will be the interest income. What accounting entry need to be passed for the interest income? Finance lease receivable account debit to interest income account, right? Again, the payment will happen. The closing value will be this one. Again, this thing has to happen for the next 2 years. You can find that the 50,000 balance has remained. And at the end of the 4th year, there is you remember there is a unguaranteed residual value also, right? Unguaranteed residual value also. So, apart from 1,25,000 in the 4th year, you have to pay 50,000 rupees as well. You have to pay 50,000 rupees as well, right? So this will become zero, right? This will become zero. This is how this accounting will happen. Is that clear? Clear in mind or clear from mind? Is it clear in mind or clear from mind, guys? I've shown you the entire calculations also. Do you want me to write the accounting entries as well? Do you want me to write the accounting entries as well? At the time of subsequent recognition, let me put the accounting entries also, okay? So that you will get the complete package for the lessor accounting. At the time of subsequent recognition, at the time of subsequent recognition, okay? So I am giving you the accounting entry for all the 4 years. Let's say write particulars here, particulars. Okay. What will the accounting entry first of all? In lessee, will do the lease receivable account, finance lease receivable account debit, finance lease receivable account debit to to interest income account, to interest income account, credit, right? So year 1, year 2, year 1, year 2, year 3, and year 4. Year 1, 2, 3, 4, right? And what is my financially receivable to interest income? What will be my interest income? In the year 1, it is 43038. In the year 2, it is how much? 34842. In the year 3, 25826. In the year 4, 15909. This is the accounting entries for financially receivable and interest income, right? And friends, what is the next accounting entry? The next accounting entry is bank account debit to lease receivable account, to lease receive account, right? And this has to be credited. In the first year, it is 1,25,000, right? In the second year, it is also 1,25,000. Third year also 1,25,000. What will be in the fourth year? What will be in the fourth year? In the fourth year, it will be 1,25,000 plus 50,000, right? This is the accounting entry which lessor will pass at the time of reporting date, at the time of subsequent recognition, right? Is that clear? He will receive the lease installment, he will recognize the interest, and he will de-recognize the finance lease receivable so that it will become zero at the end of the fourth year. You can see in this schedule, this has become zero at the end of the fourth year. Is that fine, friends? Yeah? Clear? We have completed the finance lease accounting as well. We have completed the finance lease accounting, right? Any doubt so far? So since morning, we have done the entire revision of the last 3 classes, number 1. Then we have also covered a comprehensive illustration number 37 on the request of Janvi, number 2. Number 3, we have completed the finance lease accounting in terms of the books of the lessor with a practical illustration, right? So number 3, we have completed these aspects. And now I'll going to discuss, and I'll going to let you know, guys, I'll going to discuss with you guys the sale and leaseback transaction and sublease, which is the 2 concept which is remaining in this standard, right? I'll cover these 2 concepts after the break. It's 8:20 now. Let's have a 10 minutes break. I will start at 8:31. Okay, let's have a 10 minutes break. move forward to the sublease concept. Do you have any questions? Shall I move forward to the sublease concept? Radhika has confirmed that everything is clear, sir. What about other students? I'll pause for 30 seconds. If you have any question, any doubts, if you need any clarity, I'll cover that. If not, then I'll start talking on sublease concept. Rahul has also clarified. What about others? Hitesh is asking, sir, in case of a lease accounting in the book of the lessor, if it is an operating lease, then lessor will continue to depreciate the original asset. Yes, Hitesh. In that case, lessor will continue to depreciate that asset as per the useful life, as per the economic life. Like you are depreciating the asset as per the property, plant and equipment. For example, it is a machinery and the life is 10 years. Building life is 20 years. So it has to be depreciated as per the original life. Okay. There is no nothing which is related to the lease term. If it is a case of operating lease. Guys, I hope I'm audible because I'm not getting response apart from these 2-3 students. I'm not getting response from the others. Namrata, are you clear? Whatever I explained you so far, are you clear on that? Yes. Let's discuss the sublease concept. What is meant by sublease? What is meant by sublease? Friends, so before discussing a sublease concept, let me explain you this concept with the help of a small example, with the help of a layman language example. Let's say there is a car, right? And life of the car is 10 years. Life of car is 10 years. Now what happens? There is A Limited, a company. A Limited is there. And A Limited lease the car to B Limited. A Limited lease the car to B Limited for a period of 7 years. This is A Limited, this is B Limited. So A Limited lease car to B for a period of 7 years. What is the period? The period is 7 years. So in this case, A Limited is the head lessor or original lessor. B Limited is the head lessee, or you can say that the original lessee. Now B Limited lease out this car to sublease this car to C Limited, right? So B Limited sublease the car to B Limited, sublease the car to C Limited. B Limited sublease to C Limited for a period of 5 years. For a period of 5 years. In this case, when it was a contract between A Limited and B Limited only, A Limited was the original lessor and B Limited was the original lessee. B Limited was the original lessee. Okay. B Limited was the original lessee, right? But B Limited is subleasing this contract to C Limited with C Limited. In this case, B Limited is acting a dual role. In the first contract between A and B, A is the lessor and B is the head lessee. But in the another contract between B and C, B become a lessor also. So in this case, B Limited will be the head lessee, or B Limited will also known as an intermediate lessor. Intermediate lessor. Right? Because in a contract between B and C, B has become a lessor also, which is an intermediate lessor. And this C has become an ultimate lessee. This C has become an ultimate lessee. C has become an ultimate lessee. Right? Friends, if I talk about this entire arrangement, that how this accounting will happen, there are two contracts, A to B and B to C, right? There are two contracts, A to B and B to C. Contract 1. A to B, contract to B to C, right? And if I talk about A limited and C limited, the life of A limited and C limited is pretty simple. A limited is the original lessor. A limited will always be lessor. He will always be lessor. The owner of the asset is A limited, and A limited leases to B limited. So A limited has to do the lessor accounting, right? In this case, A limited has to do the lessor accounting. And the life of the car is 10 years and A limited leases out for a period of 7 years. It means it is for the major part of the economic life. It is more than 5 years. So what will be the classification of this lease in the books of A limited? What will be the classification of this lease in the books of A limited? Is it an operating lease or is it a finance lease? Number, is it an operating lease or is it a finance lease? Yes, Rahul, it is a finance lease. In the books of A limited, in the books of A limited, it will be, in the books of A limited, it will be finance lease. It will be finance lease in the books of A limited, right? And in case of finance lease, A limited will de-recognize the car, A limited will recognize the finance lease receivables, right? A limited will do all these things. Okay, we have just understood what is the finance lease accounting in the books of the lessor. Friends, in B2C, if I talk about C limited, life of the C limited is pretty simple. He is the ultimate lessee. He is the using the asset. He is ultimate lessee. So what he'll do? The asset is for a period of 5 years. The C limited has to pay lease rental to B limited for a period of 5 years. As simple as that, C limited has to pay the rent and C limited has to recognize right of use asset and leasehold liability on the basis of payment of lease rental over a period of 5 years. So he has to calculate the present value of the future lease payment and he has to recognize the right of use asset and lease liability. He will depreciate the right of use asset over a period of 5 years because 5 years is the lease period, and he will increase the lease liability by way of interest cost and he will decrease the lease liability by way of payment of installments. So for A limited and C limited, life is pretty simple. But what about B limited, where in the first arrangement he is a lessee, in the second arrangement he is a lessor. So B limited is known as a head lessee, or B limited is known as an intermediate lessor also. B limited is known as an original lessee or head lessee as well as intermediate lessor, right? And the C limited is known as a sub lessee, or C limited is known as an ultimate lessee, right? Friends, in this case, in A to B, what B will do? In A to B, what B limited will do? Of course, B limited has to recognize right of use asset and lease liability over a period of 7 years on the basis of present value of lease payment to be payable for 7 years. Yeah, this B limited has to do. Am I right? This B limited has to do. B limited has to debit right of use asset and credit lease liability over a period of 7 years. Am I right, friends? Very simple. Accounting तो यही होगी ना, because as a lessee, B limited does not have any option to do this finance lease, operating lease. He has to capitalize right of use asset and lease liability in the books of accounts. This is the only accounting for lessee. Am I right? But friends, at the same time, in a transaction between B to C, B has become a lessor. And what asset B is having in its balance sheet? It is a right to use asset. Friends, now when B acting as a lessor in the another arrangement, which is contract number 2, B is acting as a lessor, and lessor has to do the accounting classification. Lessor has to do the lease classification, whether it is an operating lease or is it a finance lease, right? Whether it is an operating lease or it is a finance lease, the lessor has to do the classification. So friends, standard says that whenever there is a sublease, in case of a sublease, when intermediate lessor has to do the classification, whenever there is a sublease, whenever intermediate lessor has to do the classification, whether it is a finance lease or operating lease, he has to check whether the sublease period covers the major part of the life of the initial lease period. Means, friends, for checking the classification of the finance lease, the indicator talks about if the lease term cover major part of the economic life of the asset. But in case of a sublease, you are required to check whether the sublease period covers the major part of the life of the original lease period. In that case, it will be a finance lease for the intermediate lessor. Why? Because for B limited के लिए period क्या है? B limited के लिए life क्या है? It is 7 years. So out of 7 years, B limited has transferred this right to control the use to C limited for a period of 5 years, which is almost how much? 70%, which is major part of the economic life. And hence, in case of a B limited in a transaction between B to C, this B limited will de-recognize this right of use asset and recognize, B limited will de-recognize right of use asset and recognize the finance lease receivable. Why? Because this is a finance lease. For B, it is a finance lease. Why? Because out of 7 years, B limited has leased out to the 5 years, right? Is that clear? So friends, in contract number 1, A limited will do the finance lease accounting, B limited will create right of use asset and lease liability. In a contract number 2, at the same time, whatever right of use asset B has created, B will reverse right of use asset. Like in my example of finance lease, that company was de-recognizing the car and recognizing the finance lease receivable. B limited will de-recognize the right of use asset and recognize finance lease receivable. Sir, what happens with the lease liability? It will remain there. Why? Because there is a contractual obligation to pay to A limited, right? So B limited, ultimately, what happens in the books of A limited? What comes out? Finance lease receivable. In terms of B limited, what comes out? Finance lease receivable and lease liability, right? In terms of C limited, what comes out? Right of use asset. Okay. So friends, in case of a sublease, the only thing is, don't get confused. The standard talks about that whenever you have to see the lease classification, is it a finance lease or operating lease? From the lessor perspective, you have to see whether it is covering the major part of the economic life of the asset. So that is true in case of contract number 1. In case of contract number 1, because this contract number 1, A will evaluate with the total life of the car is 10 years and I am giving it for 7 years. In that case, it covers the major part of the economic life, right? But when it comes out to the B, in terms of sublease contract, in case of sublease contract, when the lessee will becomes the intermediate lessor for checking whether it is a lease, finance lease or operating lease, lessee, the intermediate lessor or original lessee will compare the period given to him versus the period transferred by him. So he'll compare with that, right? And if it is more than 50%, if it is major part of the original lease period, then it will become the finance lease in the books of the original lessee, and lessee will replace the right of use asset with finance lease receivable, right? Is that clear, friends? I hope this accounting has been clear to all of you. Yeah. Yes, Namrata, in the entire chain, only the ultimate lessee who is using the asset will recognize the right of use asset, right? Namrata, but if this would be an operating lease, for example, instead of 5 years, this would be 3 years only. This would be 3 years only. In that case, the lessee, the head lessee, will also continue to recognize right of use asset, right? And he will recognize right of use asset for 7 years. The C limited will recognize right of use asset for 3 years. Okay. So it is not a fundamental principle. Only one person will recognize right of use asset. You have to check whether the sublease period is covering the major part of the original lease period. If answer is yes, then your thing is right. But in this example, if the first contract is for 7 years and the second contract is for 3 years, in that case, B limited and C limited both will recognize right of use asset. B will recognize the rights on the basis of which he is entitled to pay to A limited. C will recognize for a period over which he is entitled to pay to B limited. right? This is how the accounting will happen. Guys, is that clear in mind or clear from mind? So friend, there is a head lessor, which is original lessor. There is an intermediate lessor, who is the original lessee, and there is a sublease. If a lessee subleases the underlying asset or expects to do so, then the head lease does not qualify as a low value lease. Friend, there is one concept more. If, and I have told you, you remember in the terms of exemption, I have told you that if the low value asset is transferring on a sublease basis, you cannot avail the exemption of low value leases, right? If the head lease, you are saying it is a low value, but you are subleasing that asset, you cannot say that it is a sublease. You cannot say that it is a sublease. Okay. So sorry, you cannot say that you cannot avail the exemption for the low value leases. Right. So guys, if you are subleasing the low value asset, you cannot avail the exemption of low value leases. Right. Second, intermediate lessor shall classify the sublease into finance lease or operating lease using the following criteria. If it is a short-term lease, 12 months or less, he will classify it as an operating lease. Otherwise, he will classify the sublease with reference to the ROU asset and not the underlying asset. Means he has to compare with the original ROU period. That means for a sublease to be classified as finance lease, sublease to be classified as a finance lease using useful life criteria, the sublease term will be compared with the term of head lease, that is ROU life and not the economic life of the asset. That is what I have explained you. Let's discuss this illustration number 41. Intermediate lessor, where the sublease is classified as an operating lease, right? Head lease. An intermediate lessor enters into a 5-year lease for 10,000 square meter of office space with entity XYZ head lessor. So here, let's say head lease, I would say head lessor, HL, head lessor is there. So head lessor enters into a contract for a period of 5 years with original lessee, which is XYZ, right? Which is XYZ. An intermediate lessor enters into a 5-year lease. Sorry, it is not head. Let's name this intermediate lessor as a PQR. PQR. And XYZ as the head lessor. Okay. So XYZ, this is a contract number 1. This is the first contract. Contract number 1. And in the contract number 1, XYZ is the lessor. He has entered into a contract with PQR. PQR is the lessee. Lessee for a period of 5 years. This is the main lease. This is the head lease. And who is the head lessor? XYZ. Who is the head lessee? PQR. Now, PQR at the commencement of the head lease, the intermediate lessor means PQR. PQR subleases. Now this PQR is an intermediate lessor, right? Intermediate lessor. This PQR is again subleasing this property for a period of 2 years, right? For a period of 2 years to the ultimate lessee, or sublessee, right? At the commencement of head lease, the intermediate lessor subleases the 10,000 square meter of office space for 2 years to sublessee. So let's say it is ABC. Sublessee is, let's say, ABC to ABC. It is the ultimate lessee or sublessee. Friends, in this case, if I talk about contract number 1, it is an office space. It is an office space. So assuming the life of the building must be more than 20 years. So XYZ, who is a lessor, has given a property to the PQR, who is a lessee, for a period of 5 years. So it is not covering major part of the economic life. So in this case, for a lessor XYZ, it is a operating lease. So XYZ continue to show the building in its books of accounts and depreciate as per the fixed asset standard. PQR will recognize right of use asset on the basis of lease payments to be made over a period of 5 years. Okay, present value basis. This PQR is subleasing for a period of 2 years, which is less than 50%. Again, it is not for the major part of the economic life. PQR continue to show the right of use asset on the asset side and lease liability on the liability side. Right? And ABC, who is the ultimate lessee, he will also recognize the right of use asset on the basis of present value of the future lease payment for the period of 2 years. Right? So ABC will also recognize the right of use asset. ABC will also recognize the right of use asset. Is that clear? ABC will recognize the right of use asset for a period of 2 years. Present value over the period of 2 years. In this case, if you will see this entire chain, XYZ as a lessor, it is a operating lease. Right? And who is XYZ? It is a lessor. PQR. Who is PQR? He is intermediate lessor. He is also the original lessee. He will also recognize right of use asset, and from the lessor perspective, it is an operating lease. From the lessor perspective, from the intermediate lessor perspective, it is an operating lease. Means he will continue to recognize this right of use asset. ABC, he is the ultimate lessee. He will recognize the right of use asset. He is the ultimate lessee. He is the ultimate lessee. He will recognize the right of use asset. Okay. Is that clear, friends? The intermediate lessor classify the sublease by reference to the ROU asset arising from the head lease. That is, in this case, comparing the 2-year sublease with the 5-year ROU asset in the head lease, the intermediate lessor classify the sublease as an operating lease. Having considered the requirement of Ind AS 116, that is one of the important criteria of useful life for a lease to be classified as finance lease, and since it is not satisfied, classify the same as an operating lease. Friends, whether the concept of this sublease is clear to all of you or it is not clear? Is it clear to all of you guys? Is that clear in mind? Is that clear in mind or clear from mind? Let me know if you have any doubt. I'll explain it again. Let me know if you have any doubt. I will be happy to explain it again. If you have any doubt, I will be happy to explain it again. No, there is no doubt. There is no doubt, guys. Namrata has requested to summarize it once. So, guys, we were discussing the sublease accounting, right? And why sublease accounting is important? It is important because there are two lease arrangement. It says that, first of all, whenever there is a sublease, there are two lease contract. One between the original lessor and the original lessee. Second, between the intermediate lessor and the ultimate lessee. There are two new concepts, which is intermediate lessor. Why it is known as an intermediate lessor? It is named as intermediate lessor because the lessee has stepped into the shoes of lessor. The lessee has become the lessor. That is why it is known as an intermediate lessor. Okay. In this case, friends, now the question arises, since the lessee is not required to do this finance lease or operating lease classification, but when he become same lessee, when become a lessor, he has to do this finance lease and operating lease classification. He has to do this finance lease and operating lease classification. If he has to do this finance lease and operating lease classification, in that case, how he will do the operating lease and finance lease classification? That question will arise. So first of all, in the first contract, the original lessor will simply be a lessor. He will see whether it is an operating lease or it is a finance lease. He will see whether it is an operating lease or it is a finance lease. If it is an operating lease, the original lessor will do the lessor accounting. He will continue to show the asset in its books of accounts, and he will depreciate the asset and recognize the rental income. But if it is a finance lease, like in this case, the life of the car is 10 years and he has leased out this car for a period of 7 years. So it is covering the major part of the economic life of the car. So if it is a finance lease, lessor will de-recognize the original asset and lessor will recognize the finance lease receivable on the basis of present value of the future lease payment plus unguaranteed residual value. So from the lessor perspective, it is clear. He will always be a lessor. What original lessee will do? Original lessee will create right of use asset on the basis of present value of future lease payment. Simple. But when it comes to contract number 2, the lessee has become the intermediate lessor. And now this intermediate lessor needs to check whether my arrangement with C, with the next contract, is a operating lease or a finance lease. Again, he has to see from the perspective, not from the asset perspective. He has to see from the perspective of the life of the ROU. And he got this asset for a period of 7 years. So he has to compare from a period of 7 years. If he has given this property for a period of 4 years or more, or a car for a period of 4 years or more to the sublessee, it means whatever life is given to him, intermediate lessor, he has transferred the right to control the use for a more than 50% of the life given to him. It means from the intermediate lessor perspective, it will become a finance lease. And he has to de-recognize the right of use asset and recognize finance lease receivable. One asset he has to de-recognize, one asset he needs to recognize. But in the illustration number 41, which we have seen recently, if instead of out of 7 years, instead of 5 years, is giving for only for 3 years. So in that case, the intermediate lessor will continue to show this right of use asset in its books of accounts, and sublessee will always create right of use asset and create a lease liability in its books of account. This is how this entire arrangement is there. Guys, whenever you are solving this problem as a chain, you will get confused. I always recommend, whenever you get a problem of sublease, divide it into 2 contracts. Contract number 1, contract number 2. The first contract is a contract where the original lessor is there, original lessee is there. And whatever is required to do, please do. Right? It means you have to do the lessor accounting, you have to do the lessee accounting. Then you should come to the sublease contract, or you can say that for contract number 1 is original lease contract. You can write for a contract number 1, you can write that it's a original lease contract. It's a original lease contract. Original lease contract. Contract number 2, you can write that sublease contract. Contract number 2 is a sublease contract, right? So you have to do the accounting independently, and all these accounting entries needs to be passed independently. For example, in this same example, for A Limited, if he has the car and it is a finance lease, A Limited will debit finance lease receivable account debit to car account. He will de-recognize the car. At the same time, B Limited will do right of use asset account debit to lease liability. This is the original lease contract accounting in the books of lessor and the lessee. Coming to the contract number 2, which is a sublease contract, this intermediate lessor will again, this B Limited will do the lessor accounting, which is finance lease receivable account debit to right of use asset accounting. De-recognition of right of use asset and recognition of finance lease receivable. Why? Because he is acting in the shoes of the lessor now. C Limited, who is the ultimate lessee, he will recognize right of use asset and credit the lease liability. I hope it is clear to all of you now. Yes, Namrata, for 3 years, ROU asset will be recognized in intermediate lessee's book. I hope it is clear to all of you guys. I hope you guys have understood this thing. Yeah? Shall I move forward? Now the time has come to discuss, I would say, one of the complex topic, sale and leaseback transaction, right? And I will say the trick of cracking this complex topic is just to understand the steps and go by the steps. You know what is the benefit for following the steps and going by the steps? First of all, it will give you comfort to crack the bigger problem into a smaller things. Second, at least you will be able to score or secure not at least full marks of the question, but at least some marks in that question which you are not comfortable with, right? So guys, my recommendation is always attempt the question, try to attempt the entire question in the exam, and please do the stepwise solution of that problem, right? Wherever you are aware, wherever you are confident, do that confidently. Wherever you are not confident, at least try to solve that problem. Okay. By following this fundamental principle in your life, I can say one thing: 50% of the marks will be secured by doing an average study, by doing an average study, right? But yes, if you have to be very confident about cracking the CA final examination, if you want to be into the merit list, of course, you have to work very hard. And guys, I can tell you one thing: in the new course of financial reporting, in the new course of CA final, when this financial reporting came, entire Indian accounting standards are there. Entire Indian accounting standards are there. And if I talk about the practical world today in India, there are very limited resources in India who are aware about the Indian accounting standards. And you guys are the brand new chartered accountant. You will be brand new chartered accountants. So when you will be able to learn these Indian accounting standards, I would say sky is the limit for you. You will be able to get the job in a good listed companies, in big companies, and not only Indian companies. You will be able to work in MNCs also. Why? Because Ind AS is nothing. It's a 99.3% cut copy paste of IFRS. And IFRS is applicable in 160 countries of the world. So by learning Ind AS, you are not making yourself comfortable in Indian economical environment. You are making yourself adaptable to environment of 160 countries. 160 countries, right? So being a financial reporting head in one of the listed company, and when I'm taking interview with so many CA freshers, I can say that people are not learning the concept by heart. People are just cramming the concept. Indian accounting standard is not about cramming. Indian accounting standards are about understanding. Okay. At some point of time, I still believe, being a student, you guys have to follow some steps. You guys have to learn the steps. To some extent, it is okay. But learn the steps with the understanding also, right? For example, whenever I've told you steps for modification, what I've told you first compute the ROU asset and lease liability on the basis of original terms. So there are two ways of solving this problem. One, just learning that step. Step number one, compute lease liability, compute ROU asset on the basis of original lease terms. That is step number one, which you can learn. Second, you can understand, okay, my first thing will always be my original lease contract. So first, my first starting point is is my right of use asset and lease liability on the inception of the contract, on the commencement of the contract. Right? So this is the first step. Without this, you cannot move ahead. So you have to understand that. In case of sublease, either you can just cram the concept. Okay. The number one, make the accounting, do the accounting in the books of the head lessor, then do the accounting in the books of the head lessee, then do the accounting in the books of the intermediate lessor. Instead of cramming these concepts, what you are required to do? You have to think from the perspective of, okay, in sublease, there are two kind of contract. One, between the original lessor and original lessee, which is original lease contract. Second, between the intermediate lessor or original lessee and the ultimate lessee. So we have to split these two contracts, right? And we have to solve this contract one by one. By understanding this concept, you will be able to understand the accounting also. In case of a sublease, 2 times you are doing the lessor accounting, 2 times you are doing the lease accounting. Why? Because there are 2 contracts, right? And whenever there are 2 contracts, of course, 2 parties are there in one contract, 2 parties are there in the another contract. So there are total 4 parties. Manta, when I'm talking about new course, I'm talking about the 4 years old back. If I talk about 3-4 years back, there was a only accounting standard, and Ind AS was covered from the perspective of overview only, right? But if I'm talking about from the perspective of a new course, I mean to say whatever you guys are doing right now. So guys, I hope my advice you find it useful, right? I hope you will find this useful. Coming to the sale and leaseback transaction. coming to the sale and leaseback transaction. What is meant by sale and leaseback transaction? First of all, let's talk about sale and leaseback transaction. In this transaction, the seller become the lessee and the buyer become the lessor. Right? The seller who is owning the asset, he is the seller who hold the asset. He sold the asset to the buyer. Buyer again lease back the asset to the seller. Means earlier the seller was holding the asset as an owner. Now the seller is holding this asset as a lessee. Now what happens, and why this sale and leaseback transaction is covered in Ind AS 116? Let me tell you. Let's say let's say a number is there. So I need 50 lakh rupees, right? For some urgent piece of work, I need 50 lakh rupees. And I called Namrata and I told her that, Namrata, I want 50 lakh rupees. Can you please lend me 50 lakh rupees? She said, no, sir. I asked Namrata, why? She said, sir, I don't know you. And I can't give you 50 lakh rupees without any security. So I told Namrata, just do one thing, Namrata. Let's enter into an arrangement, right, where I will sell you this property. Namrata said, sir, why I'll buy this property? So I said, Namrata, hold on. So I want this loan, or I want this 50 lakh rupees for a period of 5 years. So what I'll do, today I'll sell this property at a price of 50 lakh rupees. Right? And after 5 years, I will buy this property at a price of 60 lakh rupees. Or I can say that you will pay me 50 lakh rupees and every year I will pay you 12 lakh rupees. Means in the 5 year, I'll pay you 60 lakh rupees. Right? And at the end of 5 year, you will return me this property. You will sell this property again back to me. You will again sell this property back to me. And of course, I'm entering into this kind of arrangement where I'm using this property as my office building. And I told Namrata that I'll sell this property to you. You will lease back this property to me. Right? It means as an owner, I'm using this property. I'm not going to shift my any belongings. I'm not going to shift my any article or anything else. Okay. The only thing is from the owner, I will become a lessee. And I'll pay you lease rent. I'll pay you lease rent. Right. And at the end of the 5 year, I'll pay you 50 lakh rupees or 60 lakh rupees. So guys, don't you think instead of a lease transaction, this is more like a loan transaction? This is a financing arrangement. This is a financing arrangement. So guys, in this case, the seller who is holding the property, the seller sells the property to the buyer. And the buyer leases, the property back to the seller. Means the buyer become the lessor and the seller become the lessee. This is known as a sale and leaseback transaction. Sale and leaseback transaction. Now, in this arrangement, when I say that I have taken a loan, I have taken money from Namrata for 50 lakh rupees. Why? Because I have sold my building to Namrata. 50 lakh rupees. And I entered into an arrangement of purchasing back this property after a period of 5 years at 50 lakh rupees or at 60 lakh rupees, right? So guys, there is a clear-cut case of financing arrangement where I am getting money on the basis of loan and I am repaying this loan and this property will transfer to me. This is more like a payment on the basis of security. Sometimes, you know what happens? The seller got the money from the buyer and buyer will become the lessor. At the same time, just to avoid the capital gain or just to avoid the other nuisance of the transaction, the buyer and seller says that, let's do one thing. you will remain in the possession of this property, and I will enter into a lease agreement with you for this property. So let's, instead of, instead of I'll sell this property to you, you pay me the entire money in the form of lease rent. You will pay me the entire money in the form of a lease rent, right? So that when I'll get the rent, I'll get the benefit in income tax also. And the entire money has been splitted into the 5 years, and my tax liability is very low. So friends, as an auditor and as a management or as a regulator, you need to check this. Is it a sale and leaseback transaction, right? Is it actual a lease, or is it something where the transaction is happening as a financing arrangement? If it is happening as a financing arrangement, then the income has to be recognized not as per Ind AS 116, but as per other standard like Ind AS 115. Okay. Or is it actual a sale and leaseback transaction, or is it only a leasing transaction, or is it a financing arrangement? So you need to see the entire and every pillar of this entire transaction to conclude how this transaction has to happen, right? But so far you guys have understood, in sale and leaseback transaction, the seller become the lessee and the buyer become the lessor. Okay? And in case of a seller lessee and buyer lessor, seller lessee and buyer lessor, what happens? For example, if the transfer is accounted for as a sale under Ind AS 115, for example, you have concluded that yes, it is a sale. It is a sale under 115, because a sale will not be covered under Ind AS 116, it will be covered under Ind AS 115. Standard says that if yes, if it is actual a sale, it is not a financing arrangement, it is a sale, then recognize gain or loss on rights transferred to the buyer and recognize a ROU asset for the portion of carrying amount pertaining to rights retained and a lease liability. Standard says that this is a space. This is an office space. And standard says that it is actually considered as a sale transaction. So he says that if it is actually a sale transaction, then recognize gain or loss on rights transferred to the buyer. For example, for this 75%, for this 75% of the space, the lessee is not using this space. Actually, the space has been sold out and the rights have been transferred to the buyer. In that case, the gain or loss relating to this 75% space will be recognized as per Ind AS 115 profit or loss. But for this 25% space, ROU asset and lease liability is required to be recognized for this 25% space. And whatever difference will be there, it will go to the P&L. If no, if it is not a sale transaction, if it is not considered as a sale transaction, it means it is a loan transaction, financing arrangement. Seller recognizing a financial liability for the amount received on transfer and buyer recognize a financial asset. Then it will not more be a lease transaction. It will no more be a 115 transaction, revenue transaction. It will be a loan transaction. So seller will recognize a financial liability and buyer will recognize a financial asset. Is that clear? If it is not clear, it will be clear when I will be covering one practical question, right? I will be covering one practical question. And with my understanding and experience, I have summarized this entire sale and leaseback transaction into 4 steps. If the sale and leaseback transaction is accounted for as a sale as per Ind AS 115, friends, this kind of problem may be asked in the examination. This is the complex part of the problem, right? If it is not considered as a sale, then life is pretty simple. Whatever the seller has got from the buyer, it will be considered as a liability, and whatever buyer has paid to the seller, it will be considered as a financial asset. It is no more a 115 or 116 transaction, right? Friends, are you clear to some extent on sale and leaseback? Are you clear to some extent? Can you please confirm so that I'll move on? Can you please confirm? Rahul has replied, Hitesh has replied. Namrata, are you clear to some extent on the sale and leaseback transaction? Janvi has replied, okay. Yes, so guys, there are few steps which needs to be followed for sale and leaseback transaction where the sale is considered under Ind AS 115 and the lease is considered under Ind AS 116. Step number 1, steps to recognize gain or loss on the rights transferred. Means in case of a sale and leaseback transaction, how to recognize gain or loss? How to recognize gain or loss on the rights transferred? Standard says that. First of all, calculate additional financing. Calculate additional financing, step number 1. Sir, what is meant by additional financing? Additional financing means, for example, I have asked Namrata that I want 50 lakh rupees, right? And the market value of my property is 40 lakh rupees only. So guys, if I would have actually sold this property in the market, how much money I would have faced? अगर मैं एक्चुअल में 40 लाख रुपए की मार्केट वैल्यू है और एक्चुअल में प्रॉपर्टी अगर मैं मार्केट में बेचता तो कितना रुपया मुझे मिलता? हाउ मच मनी आई विल रिसीव इफ द मार्केट वैल्यू इज 40 लाख रुपीस? 40 lakh rupees? Of course 40 lakh rupees. But I have sold to Namrata on 50 lakh rupees. What does it mean? She has given me 50 lakh rupees for a property which is at a value of 40 lakh rupees. What does it mean? It means in this case there is an additional financing of 10 lakh rupees. Right? What is the additional financing? Means she has given me the money beyond the market value of the asset. So first of all, you need to compute the additional financing component if it is there. And how to compute the additional financing component? Sale price minus fair value of the asset. Right? Sale price minus fair value of the asset. So additional financing is 10 lakh rupees. Original financing is 40 lakh rupees. Additional financing is 10 lakh rupees. Now, whether this 40 lakh or 50 lakh rupees is the core financing arrangement, it is not a sale, then of course you need to create a financial liability in the books of the seller and financial asset in the books of the buyer. But if it is a sale transaction as well as additional financing component, then you need to split this thing. Calculate additional financing. And you have understood how to compute additional financing. The value of this glass is 10 rupees and I'm selling you this glass at 12 rupees. Why? Why 2 rupees extra? You are giving me a loan of additional loan of 2 rupees. Then you need to allocate, since you are paying a lease payment, and that is why it is there in the standard in 116. Whatever lease payment you are paying, you have to allocate between the present value of the lease payment and additional financing. The present value of the lease payment and additional financing. Probably whatever lease payment you are making, you are repaying your additional financing loan also, right? So that is why whatever the seller lessee is paying, he has to allocate this lease payment into the proportion of the actual lease payment and additional financing, right? And the additional financing. Okay. Is that clear? Is that clear, guys? You need to cram or you need to understand. I hope step number 1 and step number 2 is pretty clear. Step number 3. Now, you need to compute ROU asset in the books of the seller lessee. And how to compute ROU asset in the books of the seller lessee? You need to compute present value of the annual lease payment. Whatever additional financing is there, you have to reduce that, because additional financing is like a loan arrangement. First of all, you have to carve out, you have to remove that additional financing component, right? Then whatever balance you will get, present value of the annual lease payment minus additional financing, whatever balance you will get, you have to multiply it with carrying value, divide by fair value, you will get the right of use asset in the books of the seller lessee. Then you need to compute the gain or loss on the basis of right transferred to the buyer. So how to compute that? Sale price plus ROU asset. You got the money, which is sale price. You got the ROU asset, which is right to use, minus present value of annual lease payment, which you have to make, minus carrying amount the asset which was lying in your balance sheet. These are the 4 steps by which you can solve the most complex problem of sale and leaseback. If you guys have not understood, no worries, right? You will be able to understood when we will solve this illustration number 42. Right? Let's discuss this illustration number 42 and let's solve this illustration number 42. An entity who is a seller lessee sells a building to another entity. An entity who is a seller lessee sells a building to another entity who is buyer and he become a lessor. For a cash of rupees 30 lakh. For a cash of rupees 30 lakh. Guys, what is the sale price? What is the sale price? Sale price is 30 lakh. Immediately before the transaction, the building is carried at a cost of 15 lakh rupees. What is this 15 lakh rupees? Carrying value. Carrying value is 15 lakh rupees. See, the carrying value is 15 lakh rupees. Sale price is 30 lakh rupees. Okay. At the same time, seller lessee enters into a contract with buyer lessor for the right to use the building for 20 years with annual lease payment of 2 lakh payable at the end of each year. What is the lease payment? Lease payment is 2 lakh. What is the lease term? Lease term is 20 years. At the same time, the seller lessee enters into a contract with the buyer lessor. Please lease out this building to me for a period of 20 years. And every year, I'll pay you 2 lakh rupees. The terms and conditions of the transaction are such that the transfer of the building by the seller lessee satisfies the requirement for determining when a performance obligation is satisfied in Ind AS 115, revenue from contract with the customer. And the terms and conditions are such that this transfer of the building needs to be checked whether the building is actually transferred to the buyer lessor. If it is yes, so you need to recognize the gain or loss on the transfer of building as per Ind AS 115. See, the fair value of the building is also given. The sale price is 30 lakh. Fair value is 27 lakh. Guys, what does it mean? Market value is 27 lakh, but this entity is paying 30 lakh. The seller lessee is getting 30 lakh. Market value is 27 lakh. Why someone will pay more than the market value? It means there is an arrangement. So what is that arrangement? There is an additional financing. Very good, Radhika. There is an additional financing. There is an additional financing of 3 lakh rupees. Fair value is given, fair value is given, carrying value is given, and sale price is given. Okay, these three things are given in the question. Lease term is given 20 years, lease payment is given 2 lakh rupees. This is what given in the question. And discount rate is also given 12% per annum. Buyer lessor classifies the lease of the building as an operating lease. And buyer lessor has classified this building as an operating lease. Means the lessor agrees that the life of the building is probably 40-50 years and the lease is only for 20 years, right? How should the said transaction be accounted by the seller lessee and the buyer lessor? How should this transaction will be accounted for by the seller lessee and the buyer lessor? Let's solve this problem. Right? Friends, I hope you have understood the question. I hope you guys have understood the question. Let's go to the question now. Let's go to the question now. Just a minute. Sale and lease back. This illustration will give you the entire confidence on the sale and leaseback transaction, I would say. Sale and leaseback transaction, right? Since we are solving illustration number 42, we are solving illustration number 42 of the ICI study material. Illustration number 42. Right? In this case, what information is given? Fair value is given, carrying value is given, sale price is given. Okay. Fair value, carrying value. I hope my Excel file is visible, and sale price. Fair value which is given is 30 lakh rupees. 1, 2, 3, 4, 5. Carrying value in the books of account is 15 lakh rupees. 1, 2, 3, 4, 5. Sale price is 27 lakh rupees. I have the sale price is 30 lakh rupees and fair value is 27 lakh rupees. This is what which is given in the question. Lease term is also given in the question, which is 20 years. Lease payment at the end of every year, it is also given in the question, which is 2 lakh rupees. These informations are given in the question, and discount rate is also given. Discount rate is also given, which is 12% per annum, and this 2 lakh rupees is payable at the end of each year. These informations are given in the question, or let me keep this information here itself. These informations are given in the question, right? And this is how we need to calculate the impact of this transaction in the books of the seller lessee and in the books of the buyer lessor. In the books of the seller lessee and in the books of the buyer lessor. Calculate the impact in the books of the seller lessee and buyer lessor. We need to calculate the impact in the both the books. Guys, first of all, we'll compute the impact in the books of the seller lessee, who is selling the asset and who is getting the asset on a lease basis, right? So when he is selling the asset, we need to do the sale and purchase transaction and we need to recognize the gain or loss. And in terms of a lessee, we need to recognize ROU asset. So first of all, let's understand this entire accounting. Okay. Step number 1. What is step number 1? Calculate the element of additional financing. Calculate the element of additional financing. Number 1. Calculate the impact of additional financing. Is there any additional financing is there in this question? Is there any impact of additional financing is there in this question? What is the additional financing? Additional financing means that is sale price minus fair value. What is my sale price and what is my fair value? My sale price is 30 lakh rupees. What is my fair value? My fair value is 27 lakh rupees. My sale price is 30 lakh rupees. My fair value is 27 lakh rupees. Guys, there is an additional financing of 3 lakh rupees. See, just by doing this simple step, just by putting this information and doing this step, you have scored 2 marks out of 10 marks question. You have already scored 2 marks, right? And you did nothing, I would say. Simple, and don't cram the concept, just understand the concept. Why someone will pay beyond the market value? It means there is additional financing. There is an incremental loan. Okay. Is that clear? Is that clear? Clear or not clear? Step number 2. Now you need to allocate lease payment. What lease payment? 2 lakh rupees every year in the ratio of present value of lease payment and additional financing. Step number 2. Step number 2. Allocate. Step number 2. Allocate lease payment in the ratio of present value of lease payment and additional financing Allocate lease payment in the ratio of present value of lease payment and additional financing. Right? Allocate lease payment in the ratio of present value of lease payment and additional financing. So friends, first of all, you need to compute the present value of the lease payment. What is my lease payment? 20 years, 2 lakh rupees every year. This is my year. This is my lease payment. Present value factor at the rate of 12%. And this is the present value. Right? This is my years. Let's keep it till 20 years because 20-year lease term is there. Okay. This is 20-year lease payment is 2 lakh rupees. Lease payment is 2 lakh rupees every year, payable at the end of every year. So this will be your 2 lakh rupees every year. Present value factor for the first year, since it is payable at the end of year, 1 divided by 1.12. Then this divided by 1.12, so on and so forth. This will be the present value factor. And then the present value is there. And this is the total of the present value, which is your 1493,889 rounded off to, so rounding off to the nearest thousand, it will come out to 14,94,000, right? 14,94,000. Is that clear? Is that clear, friend? 14,94,000. Yeah. In this case, what is my present value of lease payment? What is my present value of lease payment? My present value of lease payment is how much? It is 14,94,000. It is 14,94,000. What is my additional financing? What is my additional financing? It is 3 lakh rupees. My additional financing is 3 lakh rupees, which is already calculated in step number 1, right? What is my lease payment? What is my lease payment? Allocate lease payment in the ratio of present value of lease payment and additional financing. My lease payment is 2 lakh rupees. I need to allocate this 2 lakh rupees of lease payment. I need to allocate this 2 lakh rupees of lease payment in the ratio of what? 14,94,000 is to 3 lakh. In the ratio of 14,94,000 and 3 lakh, right? How I will compute the lease rent relating to the right to use and lease rent relating to the payment relating to additional financing and payment relating to right to use, right? What amount I'm paying back to the buyer, lessor, in terms of additional financing, and what amount actually I'm paying for the use of the asset. How I'll compute that? 2 lakh multiply by 2 lakh multiply by 3 lakh divide by sum of 1494 plus 3 lakh. I just did the proportionate accounting. I need to pass an accounting entry right of use asset to lease liability. On the commencement date, what accounting entry I need to pass? I need to pass right to use asset to lease liability. But this 14,94,000 is not only the lease liability under Ind AS 116, right? In this 14,94,000, there is one more liability of additional financing. In this case, present value of lease payment will comes out at 11,94,000, and the additional financing is lakh. So this is how it is going to be recorded, right? Because total ये जो seller lessee है, seller lessee has to pay this 40 lakh rupees in the entire 20 years. उसको 40 लाख रुपए पूरे 20 साल में पे करने हैं. What is the present value of this 40 lakh which the seller lessee has to pay? It is 14,94,000. And out of this 14,94,000, which liability he has to recognize today, out of this 14,94,000, 3 lakh is a financial liability. 3 lakh is a financial liability. It is an additional financing. It is a financial liability. It is a financial liability, right? So although it will be a liability, but lease liability will be 1194 and financial liability, loan liability will be 3 lakh, right? This is how it is going to be. This is how it is going to be measured. This is how it is going to be recognized. Friend, 2 lakh is my lease payment. So I need to multiply this 2 lakh lease payment, multiply by 3 lakh of the loan, which is additional financing, divide by, or let's say divide by 14,94,000, which is a total payment. Okay. And I'll do the calculation here. This is the total present value of the total lease payment. Total lease payment, right? And 4160 is your value related to additional financing. And the value, the lease payment relating to right to use is your 1,59,840. This is how this accounting has to be done. Guys, are you clear on this allocation of lease payment, or should I need to explain it again? Should I explain it again, or are you clear on this allocation of lease accounting? Please tell me. It is a very, very important concept. Please tell me. It is a very important concept. It is a very important concept, friends. Please tell me. Okay, right? What we have done, we have computed the entire present value of the entire payment, which has to be made by the seller lessee. Then what we have done, out of the total present value of the lease payment, we have allocated how much the total liability relates to the right to use, how much liability relates to the loan. So the 3 lakh is pertaining to the loan, additional financing, 1194 pertaining to the use. Okay, right? And this is how the lease payment has to be allocated between 4160 and 159,839 into the two portion, loan and the right to use. Step number, what is my step number 3? If anyone who is able to remember what is my step number 3, I'm not expecting that anyone will be able to remember. Yeah. Namrita, what is not clear? Let me explain again. In a sale and leaseback transaction, you have to de-recognize the asset to some extent. You have to recognize the gain as per Ind AS 115, and you have to do the lease accounting as well for the rights which is remained with to you, the rights which you are holding as of now as a lessee. So you have to do the lease accounting as well as you have to do the revenue accounting. So how to do this accounting? Standard says that, first of all, whenever you are doing the accounting in the books of the seller lessee, first you need to see the impact, calculate the impact, whether there is an incremental or additional financing, additional loan is there or not. How will you calculate that impact of additional financing? You need to see whether as a seller, when I'm selling the asset, I'm getting the money from the buyer. If I'm getting the money from the buyer which is beyond market value, if my selling price is beyond market value, it means I am obtaining an additional loan, right? In this case, the market value was 27 lakh, but the sale price is 30 lakh. It means 3 lakh is a financing arrangement. 3 lakh is a financial liability. 3 lakh is a financial liability, right? 3 lakh is a financial liability. So friends, the additional financing is 3 lakh because it is something which is getting beyond the market value. Now, the seller lessee has to pay 2 lakh rupees every year. The seller lessee has to pay 2 lakh rupees every year. And he has to pay 2 lakh rupees every year to the extent of 20 years. Means he got 30 lakh rupees. He has to pay 40 lakh rupees for the period of next 20 years. Right? So 40 lakh rupees is not the 40 lakh rupees due to the time value of money. So what you will do? The next step is 2 lakh rupees which you are paying every year. You need to allocate how much I am paying because I'm using the asset and how much I'm paying because I have taken an additional loan. Right? I have taken an additional loan. So in that case, you have to allocate. And what is the total present value? What is the total lease liability? If had this loan will not be there, what is your total lease liability? 14,94,000. Had this loan been there, what is your total lease liability? 14,94,000, right? So friends, in this case, my total liability, I would not say lease liability, I would say my total liability is 14,94,000. Out of 14,94,000, I have to allocate lease payment also. I have to allocate this total lease payment also in the ratio of in the ratio of the lease payment and additional financing. Means I have to identify what is my liability with respect to lease and what is my liability with respect to loan. I would say this will be my lease liability on the basis of present value. And this is my financial liability. My total liability will be 14,94,000 only, right? And now I am allocating this 2 lakh. This 2 lakh which I am paying every year. I am paying 40,000 for the additional loan and I'm paying 1,59,839 for using the asset, right? This is what I am paying. Now the step number 3. What is my step number 3? My step number 3 says that calculate the right to use. Calculate the right to use asset in the books of the seller lessee. Calculate the right of use asset in the books of seller lessee. Seller lessee. Now you need to calculate the right of use asset. How you will calculate the right of use asset? Your lease payment, your total present value of total lease payment minus additional financing. Your total present value of lease payment minus additional financing, or I would say I would say that total lease liability at present value minus financial liability multiply by carrying value divide by fair value. Multiply by carrying value divide by fair value, right? Sir, what is this? So let me explain this. Then I'll explain this step. First of all, let me put the number here. What is the carrying value? What is the carrying value of the asset in the books of the seller? What was the carrying value of the asset? Can anyone tell me? Carrying value of the asset was 15 lakh rupees in the books of the seller. What is the fair value? The fair value of the asset in the books of the seller was 27 lakh rupees. In the books, not in the books, the fair value of the, right? This is my carrying value. This is my fair value. Carrying value means I was showing, the seller lessee was showing 15 lakh rupees of the asset in their books of accounts, in its books of accounts. The market value of the asset was 27 lakh rupees. And what is your total lease liability? Your total lease liability on the basis of present value is how much? It is 3,94,000 is your total lease liability. It is your total lease liability. Okay. Total lease liability present value is, and this is your total lease liability. I'll write this as a total lease liability at present value. Total lease liability 1494 minus additional financing. Or not additional financing, financial liability. It is how much? It is 3 lakh. This will give you 11,94,000, which is your now 11,94,000. See, 3 lakh is your loan. 3 lakh is hardcore loan, completely loan. So 11,94,000 you are paying for using the asset. 11,94,000 liability is there for using the asset. And when I will proportionate this 11,94,000 into 15 lakh divided by 27 lakh, it will give me the right of use asset. It will give me the right of use asset. What is my right of use asset? My right of use asset is 11 lakh 94,000 multiply by what? Multiply by what was the asset in my book? Earlier 15 lakh of the asset was there in my book. What is the fair value of the asset? It is 27 lakh. It means 6 lakh 63,333 is the right of use asset. Are you getting me? I am replacing my original asset, which is at 15 lakh rupees. I am replacing my original asset with the rights of 20 years, right? So then I will compute what is the total payment which I am making. I am making a payment of 11 lakh 94,000. 3 lakh is a separate, 3 lakh is a complete loan. It is additional financing. It is beyond fair value. So 11 lakh 94,000 I am paying. And how much asset I am replacing with that? I am replacing an asset of 15 lakh rupees. What is the market value of this asset? 27 lakh rupees. It means I am getting a right of using this asset to the extent of 6,63,333 rupees, right? This is the calculation of right of use asset. Now the next step, step number 4, compute gain or loss on sale of rights transferred on the asset. Step number 4, gain or loss, compute gain or loss. Compute gain or loss on what? Compute gain or loss on what? On sale of rights transferred on the asset. Compute gain or loss on sale of rights transferred on the asset. Okay. Sorry. Compute gain or loss on sale of rights transferred on the asset. How will you compute this gain or loss? See what you are getting as a seller. What you are getting? You are getting a money. You are getting a right of use asset. But what you are foregoing? What you are leaving? You are leaving a carrying value of the asset which is 15 lakh rupees. You have also incurred a loan of 3 lakh rupees, right? You have also incurred a liability of 11 lakh 94,000 rupees, right? This is what what you are foregoing. As a seller, what you are getting? Bank account debit. Bank account debit. Okay. By how much? Bank account will be debited by how much? How much money you are getting? You are getting sale price of 3 lakh rupees, right? You are getting an asset also, right, to use asset, because you are using this property for 20 years. Right? And you are also incurring a liability too, lease liability, two, financial liability. What is your lease liability? 1194. What is your financial liability? 3 lakh. But you are also foregoing one asset too, building, right? Two building. And what is the carrying value of the building? The carrying value of the building is 15 lakh rupees. This is also you will be crediting in your books of accounts. If you will see this total of debit and credit, your debit is more, your credit is less. It means you are getting an income. And what is that income? What is that income? Gain on rights transferred to gain on rights transferred. To gain on rights transferred. This will be credit, right? And what is the amount of the credit? What is the amount of the credit? 669,333. Right? This will be the amount of the credit. This is bank account debit, amount received by seller lessee. Right of use asset for using the asset for 20 years. Okay, to gain on rights, balancing figure. 15 lakh rupees. Asset derecognized. Book value. 1194. Liability. Lease liability relating to the use of asset. Financial liability. Additional loan. Loan. Which is money received beyond market value. Is that clear, friends? I hope after doing this, all these steps, you guys are able to clear that when the company, when the seller lessee is getting 30 lakh rupees, he is selling its asset, he is using the property for 20 years, sort of things he is doing, right? So what if you will see the step number 4, he'll get the 30 lakh rupees of money, he will get a right of use asset, he has foregone it's 15 lakh rupees of building, he has also created a liability of 1194, 3 lakh rupees of financial liability is there, and a gain which he has to recognize is 669,333. Why gain? Because the market value, the carrying value of the asset was 15 lakh and he has sold at 30 lakh rupees, right? So this is how this entire accounting has to happen. This is how this entire accounting has to happen. Now, friends, talking about the buyer lessor, what buyer lessor will do? What buyer lessor will do at the time of initial recognition? What buyer lessor will do? This is the seller lessee accounting. Now, let's talk about the buyer lessor. Buyer lessor. Buyer lessor will do building account debit, right? And PPE principle says that PPE fixed asset has to be recognized on the basis of cash price equivalent, on the basis of fair value, cash price equivalent. It has to be recognized at 27 lakh rupees, right? Building account debit. Then financial asset, which is loan asset, financial asset, loan account debit, right? This will be debited, debit 6 lakh rupees. And this buyer lessor has paid to bank account. He has paid how much? He has paid 30 lakh rupees. Sorry, it is right. This is the accounting in the books of the buyer lessor. What will be the subsequent recognition? What will be the subsequent recognition? The buyer lessor will, for this loan asset, now for this loan asset, this building will be there in the books of the buyer lessor. But how this financial liability will be completed, how this financial liability will be crystallized? Subsequent recognition. Subsequent recognition. Now, how many years are there? Years. Then your after years, your opening balance. Opening balance. Then there will be interest income because he will get an interest. You remember, we have told you that 40,000, this 40,000 is pertaining to the payment relating to the loan, additional financing from the lessee perspective. Lessor will also recognize money, income, interest income. Then there will be your lease payment, and then your closing balance. Closing balance. These are the years. And what is your opening balance? Opening balance is 3 lakh rupees. Opening balance is 3 lakh rupees, right? What is the interest income at the rate of 12%? You remember the discounting has happened at the rate of 12%. 3 lakh multiplied by 12%. The payment is minus 4161. Remember, this is the payment. This is the payment now relating to the loan in the step number 2, where you have allocated the 2 lakh rupees into these two things. The closing balance would be this plus this minus this, right? This will become your opening balance, so on and so forth. This will happen. At the end of 20 year, you will find that this amount will become zero at the end of 20 years. This has become 116. This is just a insignificant number due to this decimal thing, because I have rounded off that 1194. So it just is 216 here, 216 here, right? It becomes zero. Right, friends? Is that clear? Is that clear? I hope it is clear. And every year, for 20 years, the lessee, the buyer lessor will recognize the interest income. And what accounting entry buyer lessor will pass? The buyer lessor will pass an accounting entry, and what he will pass? He will pass interest income to loan asset. Interest income account debit, loan asset account debit, loan asset account debit to interest income. He'll pass an accounting entry, loan asset account debit to interest income for this interest income completely, right? For this interest income. And every year he will pass an accounting entry, bank account debit to loan asset, right? Credit, which is by example in the first year. If I talk about the first year, what is the amount with which the accounting entry needs to be passed? 36,000. Interest income recognized, and amount received is minus 4161. Installment received. Is that clear? And the buyer lessor, because the buyer lessor has a operating lease classification, he will also make an entry, bank account debit to lease rent account, right? Credit. This is by how much amount? 4161 and 159,839. This is the total of 2 lakh rupees, right? The split of 2 lakh rupees. This is the subsequent recognition in the books of the buyer lessor. So this is the initial recognition, and this is the subsequent recognition, right? Subsequent recognition. I hope this is clear to all of you. In case of sale and leaseback transaction, I have covered the accounting in the books of the seller lessee and the accounting in the books of the buyer lessor. In the books of the buyer lessor, it is pretty simple, but in the books of the seller lessee, what you are required to do, first of all, you have to calculate, is there any additional loan? If it is there, then you have to allocate your annual payment or monthly payment between the lease liability and the additional loan, right? After that, you have to compute the right of use asset. How you will compute the right of use asset? What you are paying for your actual use, right? For example, in this case, lakh you are paying for the loan, but 1194 you are actually paying for the right of use, right? So you have to do the pro rata. For example, 1194 you are paying, and you are also replacing your 15 lakh rupees of asset, and the market value is 27 lakh rupees. So you have to compute right of use asset by actual payment for right of use, multiply by carrying value, divide by fair value. It will give you the value of the right of use asset. Then you need to compute what is my gain or loss on the sale of rights transferred on the asset, right? Then you will recognize the rights on the gain on the rights transferred, which is as per Ind AS 115 revenue standard, right? This is how this entire sale and leaseback accounting has to happen. I hope you guys have understood this accounting. Namrata, Janvi, are you able to understand this accounting? Are you able to understand this accounting or not? Guys, I know it is pretty complex, but when you go with the understanding, when you go step by step, probably you will be able to understand, right? And of course, this area needs a lot of practice. I would request, please do the revision at least for 2 times for the sale and leaseback transaction, right? Yes, you need to practice it. Friends, today, as promised, I did the complete revision of the last 3 lectures on Ind AS 116. And today I have also covered the illustration number 37, which includes increase in the scope and decrease in the scope at the same time. I have also covered the finance lease accounting in case of a lessor. I have also covered the sublease accounting, where I have also talked about one of the illustration. I have also covered the sale and leaseback. I would say not a small standard, it is a very large standard, and not a simple standard. Rather, it is one of the very good level of standard. It is one of the good standard, right? In this case, friends, I would request to all of you, please do a lot of practice to understand Ind AS 116 very well. This is not important only from the exam perspective. This is important from the real life perspective as well, right? When you go to the industry, when you go into the practice consulting, probably interviewer will ask question from this standard. So all the best, guys. All the best for your examination. All the best for your preparation. And just be safe, be happy, and do a lot of practice. And I would request, do all the questions, solve all the problems from ICI study material and the RTPs. Thank you so much. Bye-bye. Take care.